Welcome to our fun little study group for PP 5375, Economic Analysis for Public Policy and Management. These are the readings from Section '07, Profit Maximization and Competitive Supply. And this is our deep dive. We've taken the source material. You've got the theory details from 00PIND1.pdf, those useful policy summaries and notes in 10note1.pdf, and the slide frameworks in 10ppx1.pdf. We've pulled it all together into, well, hopefully one cohesive conversation. Our mission today, it's tackling that really fundamental question every single firm faces: how much should we produce? So this deep dive is kind of our shortcut to getting our heads around the economic logic behind that big decision.
Exactly. And that logic, it's way bigger than just thinking about shareholder value, you know? For those of you heading into public policy management roles, really understanding profit maximization and its effects is absolutely vital. You've got to be able to predict, with some accuracy anyway, how private businesses are going to react to regulations or taxes or maybe subsidies. And it's not just private firms. As Source 2 points out, a lot of government-run entities, these public enterprises, they're often set up to be self-sufficient. They need to finance their own operations through net revenue, which basically means making a profit or at the very least breaking even. So these competitive models, they give us the framework for setting those kinds of operational goals.
Okay, right. Let's unpack this then. Before we even talk about profit, we need to set the scene, don't we? The environment the firm operates in. We should probably start with the baseline model, the sort of idealized version from Source 1, the perfectly competitive market. What are those three core assumptions, the non-negotiables that define this kind of market, and what do they really mean in practice?
Okay, the first one, and arguably the most critical, is that firms have to be price takers. What this means is the individual firm's output is just so small compared to the whole industry, tiny. So its own decisions like making 10% more or 10% less, they have basically zero effect on the market price. They just have to accept the price that's set by the overall industry, supply and demand. Take it or leave it, essentially.
Right. So like the example in the text about the small light bulb distributor, if the market price is, say, $2 wholesale, I can't just decide to sell mine for $2.01. If I try, poof, all my customers vanish because they can just instantly buy from someone else at the market price. I'm basically captive of that price. And the demand curve I face as a single firm, it's completely flat, perfectly horizontal.
Exactly. And that applies to consumers, too, for these kinds of goods. You don't get to haggle over the price of copper just because you want an extra ton. You take the price.
That perfectly flat demand curve, it leads straight into the second assumption, doesn't it?
It does. Product homogeneity. The products from all the different firms in the market have to be identical, or at least so similar that buyers see them as perfect substitutes. Think pure commodities: corn, oil, copper, certain types of lumber, sheet steel, the basic stuff. A buyer just doesn't care if they get copper from firm A or firm B as long as it meets the standard grade. No preference.
And that's so important because it explains why the price taker is so vulnerable. Right? If the products were different, say I sold premium brand light bulbs and you sold generic value bulbs, then I could maybe charge a little bit more without losing everybody.
Exactly. That product differentiation gives you a little bit of wiggle room, some market power.
Like Haagen-Dazs ice cream versus the store brand. They've convinced people their product is different, heterogeneous, so they escaped that pure price taker trap.
Precisely. And the third piece needed to keep this intense competitive pressure going is free entry and exit. This just means there aren't any significant special costs, could be financial, legal, whatever, that make it really hard for a new company to jump into the market and start producing. Or, just as importantly, for a company that's losing money to get out easily, to shut down and liquidate its assets without some massive penalty.
So things like patents in the pharmaceutical industry, that's a huge legal barrier to entry. It stops competition dead in its tracks for a while.
Absolutely. Or think about trying to start a new company to build passenger jets. The sheer amount of upfront investment, the factories, the R&D, billions, and a lot of it you can't easily sell off if things go wrong. Those are massive barriers, those industries. Definitely not perfectly competitive.
Okay, so those are the three pillars: price taking, homogeneity, free entry exit.
Right. And it's worth saying very few real-world markets tick all three boxes perfectly. It's an ideal model. But for policy analysis, the real question is often whether a market is highly competitive, even if not perfectly so.
And Source 1 makes a good point here. It's not just about counting the number of firms. You could have, say, 50 companies.
But if they're all secretly colluding on price, then it's not competitive at all, is it?
Exactly. And conversely, you might only have 3 or 4 firms in an industry.
But if the market demand is incredibly sensitive to price, highly elastic, we'd say,
Meaning customers know everything and can switch instantly with no cost.
then those few firms might still behave very competitively. Because if any one of them tries to nudge the price up even a tiny bit,
When they lose all their business, they still face that almost horizontal demand curve individually.
right. So the elasticity of demand facing the individual firm is often a better indicator of competitiveness than just the firm count. That's crucial for knowing where policy interventions might actually be needed or effective.
Okay, let's pivot now to the core idea guiding what the firm actually does. Profit maximization.
Right. And the standard assumption in microeconomics is, yes, firms try to maximize profit. Now, people sometimes push back on this. Managers might have other goals in the short term, maybe boost revenue to hit a bonus target or pursue social initiatives.
Sure, that happens.
It does. But the argument is that over the long run, the market puts intense pressure on firms. Those that don't consistently maximize their long-run profit are just, well, they're less likely to survive. It's a kind of economic natural selection.
So even a company that, say, donates heavily to public television, as mentioned in the source.
Often that's seen as building long-run goodwill, which ultimately helps the bottom line. It might look altruistic, but there's usually a long-run financial rationale underneath.
It's a pretty robust assumption for modeling then. But especially for this audience focused on public policy, we should probably acknowledge organizations that explicitly have different goals, right?
Mhm.
Sources 1 and 2 talk about co-ops, for instance.
Yes, good point. Cooperatives are different. They're jointly owned by their members, and the goal is usually mutual benefit, not maximizing the organization's own profit.
Like a food co-op, their aim is to get groceries to members as cheaply as possible.
Exactly. The members themselves are still maximizing their own utility or profit, but the co-op entity itself isn't trying to maximize its surplus in the same way a corporation would.
And how does that contrast with, say, a condominium? People sometimes mix those up.
Yeah, there are different structures. In a condo, you own your individual unit outright. Then there are common areas, hallways, roof, maybe a pool that are jointly controlled by an association. The governance is usually simpler than a co-op.
Source 1 had that fascinating deep dive into New York City housing, example 8.1, I think. It mentioned co-ops historically vastly outnumbering condos there, which is unusual for the U.S.
That's right. And the economic analysis is really revealing. Studies show that owning an apartment as a co-op meant giving up something like 15.5% of its potential market value compared to an identical condo.
Wow, that's a huge difference. Why would people accept that?
Because they placed a very high value on something non-monetary. Selectivity. Co-ops typically have boards that approve potential buyers. You get to choose your neighbors, essentially.
Ah, so they're willing to pay a hefty financial price, that 15.5% difference, for the ability to control who moves into their building.
Exactly. It shows how economic models can help us quantify the value people place even on non-financial goals like, social cohesion or vetting neighbors. It's not always about the dollars and cents profit.
That's a great illustration. Okay, but let's get back to the firms that are focused on maximizing financial profit. There's a universal rule here. The bedrock principle that applies to any firm, competitive or not. Profit, which we call PI, is just total revenue minus total cost C. Simple enough, is kudos.
Right. And to make profit as large as possible, you need to find the output level, Jillers, where producing one more unit adds exactly the same amount to your revenue as it adds to your cost. Think about it. If adding one more unit brings in more revenue than it costs, you should make it, right? Your profit goes up.
Yeah.
And if adding one more unit costs more than the revenue it brings in, you definitely shouldn't make it. Your profit would go down.
So the sweet spot is right where the extra revenue equals the extra cost.
Exactly. Mathematically, we say the change in profit with respect to output, delta Q EA, needs to be zero. Since profit is R minus C, this means the change in revenue must equal the change in cost.
And we have terms for those changes. Marginal revenue, MR, the extra revenue from one more unit, and marginal cost, MC, the extra cost of one more unit.
Correct. So the universal profit maximization rule for any firm is choose the output level $2 where marginal revenue, MR, equals marginal cost, MC.
Okay, universal rule, MR, MC. Now, how does this apply specifically to our perfectly competitive firm?
This is where the price taker thing becomes crucial. Remember that horizontal demand curve. It means that if the market price is, say, $20, the firm can sell one more unit or 10 more units, and it still gets $20 for each one.
So the additional revenue from selling one extra unit, that's just the price itself.
Exactly. For a competitive firm, marginal revenue, MR, is always equal to the market price, P, and since average revenue, AR, total revenue divided by quantity, is also just the price per unit, we get this key identity for competitive firms. Price, P, average revenue, AR, marginal revenue, MR.
Okay, so if the universal rule is MR equals MC, and for a competitive firm MR equals P, then the rule simplifies quite a bit.
It simplifies dramatically.
Yeah.
For the competitive firm, the profit maximizing rule is simply choose output $2 where marginal cost MC equals price.
MCP. That's much easier to work with. It means the firm just needs to look at its own marginal cost curve and the market price and find where they intersect.
Precisely. The firm's optimal output decision is read directly off its cost structure, specifically that MC curve.
All right, let's focus on the short run now. This is the period where some things are fixed, right? Like the factory size, the big machinery. The firm can't instantly change those.
Correct. Capital is typically fixed in the short run, so the firm's decision is mainly about how much of the variable inputs to use labor, raw materials, given its fixed plant size, how much should it actually produce right now.
So graphically, we're looking for where the price line, which is also the MR line for a competitive firm, crosses the marginal cost curve.
Yes, but with one important caveat. The intersection must be on the part of the MC curve that is rising.
Why rising?
Well, think about it. If price equaled MC while MC was falling, it would mean that producing even more would lower your marginal costs further. You wouldn't want to stop there. You'd keep going until MC starts rising and hits the price level. So profit is only maximized where PMC and MC is increasing.
Okay, makes sense. And the actual profit the firm makes in the short run. That's the difference between the price and the average total cost ATC at that optimal quantity, $10. If P is above ATC, you've got positive profit.
Right, represented by that rectangle on the graph between the price line and the ATC curve over the quantity produced.
But here's the tricky part, the real short-run dilemma. What if the market price drops and P falls below ATC? The firm is losing money on every unit, on average.
This leads us straight to the crucial short-run shutdown rule. Just because a firm is losing money, PATC, doesn't mean it should immediately stop production.
Why not? If you're losing money, why keep going?
Because of those fixed costs we talked about. In the short run, they're sunk. You have to pay them whether you produce 0 units or 1,000,000 units. Rent, insurance, payments on inescapable capital. Those costs don't disappear if you stop production temporarily.
Ah, okay. So the decision isn't about making a profit versus a loss. It's about minimizing the loss.
Exactly. The rule, as laid out in the sources, is this. A firm should shut down production only if the revenue it gets from selling its output is less than its variable cost VC of producing that output.
So if the money coming in doesn't even cover the cost of the labor and materials used right now,
then you shut down. We usually express this rule using averages. Shut down if price, P, is less than average variable cost, ABC.
okay, PAVC means shut down. What's the logic there?
If the price you get per unit, P, is higher than your average variable cost per unit, AVC, then every unit you sell covers its own direct costs, labor, materials, and contributes something extra towards paying off those fixed costs you're stuck with anyway.
So operating actually makes your total loss smaller than if you shut down and paid all the fixed costs with 0 revenue coming in.
Precisely. But if P drops below AVC, then producing each unit actually costs you more in just variable costs than you get back in revenue. Operating makes the hole deeper. You're better off shutting down immediately and just eating the fixed costs.
This shutdown rule fundamentally defines the firm's supply curve in the short run then.
It does. Since the firm always chooses output where P equals MC, as long as P is above the minimum AVC, the firm's short-run supply curve is simply the portion of its marginal cost MC curve that lies above its minimum average variable cost ABC point.
Below that minimum AVC point, the supply is 0, because the firm would shut down.
Correct. The MC curve is the supply curve, but only the part that's relevant operationally.
We can see this play out in that aluminum smelting plant example, example 8.2. The costs weren't smooth there, they jumped.
Right. The example had MC at, say, $1,140 per ton for output up to 600 tons, using 2 shifts. But if they added a 3rd shift with overtime, the MC jumped to $1,300 per ton for output between 600 and 900 tons.
So if the market price was $1,250,
then P, $1,250, is greater than MC, $1,140 for the 600 tons, so they produced that. But P, $1,250, is less than the MC, $1,300 for the 600 first ton, the first overtime ton. So they stop at 600 tons, they cover variable costs, maybe contribute to fixed costs, but the overtime isn't worth it.
but if the price jumped up to $1,360,
Now P, $1,360 is greater than the MC of overtime, $1,300. It makes sense to run the third shift. They'd increase output up to 900 tons, where presumably MC would rise again or hit capacity.
And if the price fell way down to $1,100, assuming $1,140 was above the minimum AVC?
They'd stop production entirely. P, $1,100, is less than the MC, $1,140 of even the first block of output. They shut down operations, but they don't necessarily exit the industry yet. They wait, hoping prices recover.
That example really clarifies the PMC rule on the margin, and it leads into that managerial guideline the sources mention. Don't use average variable cost as a substitute for marginal cost when making output decisions.
Yes, that's a critical mistake managers can make. AVC is an average over all units produced so far. MC is the cost of the next unit. Especially if MC is rising sharply, like using expensive overtime, relying on the lower AVC figure will trick you into producing too much.
Like in their example, if regular labor is 30 unit and overtime is 50 unit and materials are $8, the MC of an overtime unit is $58. But the AVC across all units might only be $42.
Yeah.
If you compare price to the 42 LVAC instead of the $58 AMC, you might produce units that are actually losing you money on the margin.
Exactly. Always use PMC for the output decision. AVC is only for the shutdown decision.
Okay, so we have the individual firm's short-run supply curve, the MC, above minimum AVC. How do we get the supply for the entire market or industry in the short run?
That's actually straightforward in the short run. You just do a horizontal summation. You add up the quantities supplied by all the individual firms in the industry at each possible price.
So if at a price of $10, firm A supplies 5 units and firm B supplies 7 units, the market supply at $10 is 12 units.
Correct. You just sum them horizontally across all firms. And this resulting short-run market supply curve will generally be upward sloping.
Why upward sloping?
Because of diminishing marginal returns within each firm, as firms try to produce more in the short run with fixed capital, their marginal costs tend to rise. So to get more total output from the industry, the market price has to rise to cover those increasing marginal costs.
And the steepness of that slope, its responsiveness to price changes, that's measured by the market supply elasticity, right?
Yes. Saras tells us the percentage change in quantity supplied for a 1% change in price. It's always positive in the short run.
And why do policymakers care about ESIS?
Well, it tells you how easily the industry can ramp up or down production in response to price signals or shocks. If S is a low, inelastic supply, it means MC rises very quickly, firms hit capacity constraints fast. A price increase won't bring forth much more output.
Like maybe specialized manufacturing with limited skilled labor.
Could be. Whereas if S is high, elastic supply, it means MC rises slowly. Firms can expand output significantly without needing a huge price hike, maybe an industry using readily available inputs.
So if you're thinking about a policy like a price ceiling, a low SE would warn you that you're likely to cause severe shortages because suppliers just can't produce much more at the capped price.
Exactly. Understanding supply elasticity is crucial for predicting policy impacts.
Okay, before we jump fully into the long run, there's this related concept we need to define. Producer surplus, PS.
Right. Producer surplus is a measure of the benefit producers get from selling in the market. It's calculated as the sum, across all the units produced, of the difference between the market price they receive and the marginal cost it took to produce each unit.
Visually, on the graph, it's that area below the horizontal price line and above the upward sloping MC curve out to the quantity dollars.
Correct. It represents the total revenue producers receive over and above the cumulative marginal cost of production.
Now, the sources are really clear on this point. In the short run, producer surplus is not the same as profit. Why is that distinction so important?
It's crucial because of fixed costs. Remember, profit is total revenue minus total cost, which includes fixed costs. Producer surplus, however, is mathematically equivalent to total revenue minus variable costs.
So PS equals RVC, and profit equals RVCFC.
Exactly, which means producer surplus equals profit plus fixed cost. PS equals tax profit plus FC2. As long as there are positive fixed costs in the short run, producer surplus will be larger than profit.
So what does PS really represent then?
It represents the total earnings the firm gets above its variable costs. This surplus is what's available to cover the fixed costs and, if anything is left over, contribute to profit. It's a measure of the gain from operating compared to shutting down, where PS would be zero.
Okay, that clarifies PS. Now, let's make the leap to the long run. This is where everything can change. Firms can adjust plant size, new firms can enter, old ones can leave, All inputs are variable.
And this shift requires us to be really precise about what we mean by profit. We need that distinction between accounting profit and economic profit that's covered in all the sources.
Right, accounting profit. That's what most people think of as profit, right? The number in the company's income statement.
Pretty much. It's total revenue minus the explicit costs, the actual cash outlays for things like wages, materials, rent, interest payments, depreciation recorded by the accountants.
Straightforward, but incomplete from an economist's viewpoint.
Very incomplete. Because it ignores implicit costs. Economic profit subtracts total economic costs, which includes both those explicit costs and the implicit costs.
And the main implicit cost we're usually concerned with here is
The opportunity cost of capital. This is huge. It's the return the firm's owners could have earned if they had invested their capital, their money, their time, their resources in the next best alternative use.
so if I run a small business and make $100,000 in accounting profit, but I could have earned $80,000 working for someone else with the same effort and invested my capital in bonds, earning $10,000.
Then your total opportunity cost is $90,000. Your economic profit is only $100,000 minus $90,000, which is $10,000. Even though your accountant says you made $100K.
This is fundamental to understanding the long-run equilibrium condition. Zero economic profit. People hear zero profit and think it's bad, like the firm is failing.
Yeah, it's a common misunderstanding. Zero economic profit does not mean the firm is just scraping by or about to go under. It means the firm is earning a normal rate of return on its investment.
It's doing exactly as well as its resources could do in their next best use.
Precisely. It's covering all its explicit costs and compensating its owners fully for the opportunity cost of their capital and effort. Earning zero economic profit is the signal that says, stay put, you're doing fine, you couldn't do better elsewhere, adjusted for risk.
And it's also the signal to outsiders not to enter the market,
Right.
because there are no excess profits to be had.
Exactly. This drives the whole dynamic of long-run competitive equilibrium. If, for some reason, firms in a competitive market are currently earning positive economic profit, price is above the minimum of long-run average cost, LAC.
That's like a big neon sign flashing easy money here.
You got it. Capital flows in, new firms enter the market. This increases industry supply, shifting the supply curve to the right.
More supply means the market price starts to fall.
And it keeps falling until it reaches the point where price equals the minimum LAC. At that point, economic profit is back to zero, and the incentive for new firms to enter disappears.
And the reverse happens if firms are making losses, negative economic profit, P minimum LAC.
Right. Firms realize they could do better elsewhere. They start to exit the industry. Supply shifts left, the price rises, and losses shrink. Exit continues until the price rises back to the minimum LAC level, restoring zero economic profit for the remaining firms.
So the long-run competitive equilibrium is stable only when three things hold true simultaneously.
1. All firms in the industry are maximizing their profit, meaning they're producing where POAP equals long-run marginal cost, LMC.
2. No firm has an incentive to enter or exit, which means all firms are earning zero economic profit, P equals minimum LAC.
And 3. The market clears quantity supplied equals quantity demanded at that equilibrium price.
Okay, but what about situations where some firms seem persistently better than others? Maybe one firm has a secret process or a fantastic location near the highway. They might show higher accounting profits year after year. How can their economic profit still be zero?
This brings us to the concept of economic rent. This helps reconcile those differences.
Rent again. Not like apartment rent. What does it mean here?
Yeah, economic rent is the difference between what firms are willing to pay for a scarce productive input, like that great location or unique patent or exceptional talent, and the minimum amount necessary to actually obtain and keep that input.
Okay, walk me through the river location example from the text again. That helps make it concrete.
Sure. Imagine two widget firms, A and B. They're identical, except firm A is right on a river, saving $10,000 a year in shipping costs compared to firm B inland.
So all else equal, Firm A's accounting profit will be $10,000 higher than Firm B's.
Right. Now, does firm A have a $10,000 positive economic profit? No, because that riverfront location is a scarce, valuable input. If firm A rents the land, the landowner knows about that $10,000 cost advantage and will charge $10,000 more in rent for the river spot compared to the inland spot. The advantage is captured in the rent payment and explicit cost.
And what if Firm A owns the land?
Same result, just through opportunity cost. Firm A could rent its valuable land out to someone else for that extra $10,000. By using the land itself, it's foregoing that potential income. That foregone income is an implicit cost, an opportunity cost.
So that $10,000 cost advantage becomes the economic rent associated with the land. It's either paid out explicitly as higher rent or implicitly as a higher opportunity cost of owning the land.
Exactly. And when firm A subtracts this $10,000 economic rent, whether explicit or implicit, from its $10,000 higher accounting profit, its economic profit comes right back down to zero, just like firm B's.
Wow. So the market mechanism essentially assigns the value of that scarce advantage to the advantage itself, the land, the patent, the skill, ensuring that the firm using it still only earns a normal zero economic profit in the long run.
That's the power of the competitive model, and it leads to a final point about producer surplus in the long run.
What happens to PS in the long run?
In long-run competitive equilibrium with zero economic profit, any producer surplus earned by a firm consists entirely of the economic rent generated by the scarce, valuable inputs it controls. The surplus doesn't come from operational profit anymore. It's purely the return captured by those unique advantages, which have already been factored into the firm's costs.
Okay, so we understand the long-run equilibrium for a firm. Now, what about the long-run supply curve for the whole industry? You said we can't just sum up the firm's supply curves like in the short run.
Right, because the number of firms isn't fixed anymore. Firms are entering and exiting. So the shape of the long-run supply, LRS curve, depends entirely on how the costs of the inputs firms use change as the entire industry expands or contracts.
And the sources classify industries into three types based on this. Let's start with the benchmark case, the constant cost industry.
In a constant cost industry, when the industry expands, more firms enter, total output rises. The prices of the inputs it uses don't change. Think about an industry that uses inputs that are available in huge quantities relative to the industry's needs, maybe unskilled labor in a large region or widely available raw materials. The industry can double in size, but it doesn't push up wages or material prices noticeably.
So if demand increases, the price initially goes up, attracting new firms.
Right. New firms enter. But because their cost curves don't shift, input prices are constant, they can produce profitably at the original minimum average cost. Entry continues, shifting the short-run supply curve rightward until the price is pushed all the way back down to that original minimum long-run average cost employers.
Meaning the long-run supply curve for this industry is
Perfectly horizontal, infinitely elastic. The industry can supply any amount demanded in the long run at that constant price P to lid $1. Source 1 gives coffee as an example. Land suitable for coffee is apparently quite abundant globally relative to demand, so expansion doesn't significantly raise land or planting costs.
Okay, that's constant cost. What about the opposite, the increasing cost industry?
This is probably more common. Here, when the industry expands, it does bid up the prices of at least some of its key inputs. This happens when the industry relies heavily on inputs that are scarce or specialized, maybe skilled labor where supply is limited, specific types of land, or particular mineral resources.
So when demand increases and price rises, new firms enter.
But their entry increases the demand for these scarce inputs, pushing up the input prices for everyone in the industry. This shifts the cost curves, AC and MC, of all firms upwards.
So the new long-run equilibrium after entry stops will have to be at a higher price than the original one because the minimum average cost itself is increased.
Exactly. The new equilibrium price, fee P33, will be higher than the initial price, P-town owners. This means the long-run supply curve for an increasing cost industry is upward sloping.
What are some examples?
The oil industry is classic. As demand grows, companies have to drill in more difficult and expensive locations, deep water, oil sands, raising the cost for everyone. Urban housing is another. Expanding the housing stock means building on less desirable land or using more expensive high-rise construction due to scarce land, pushing up costs and rents.
So for policy, this means trying to significantly increase output in these industries will inevitably lead to higher long-run prices for consumers.
Correct. And then there's the third, somewhat rarer case, the decreasing cost industry.
Wait, costs go down as the industry gets bigger? How does that work?
It usually happens because of external economies of scale. As the industry grows large, it might become efficient enough to support specialized input suppliers, or better transportation networks might develop, or firms might benefit from shared knowledge or infrastructure. These things can lower the costs for all firms in the industry.
So if demand increases, price rises, firms enter.
But the very act of the industry growing larger triggers these cost reductions. The AC and MC curves for all firms actually shift down.
Meaning the new long-run equilibrium price, P 3000, will be lower than the original price.
That's right.
The long-run supply curve for a decreasing cost industry is downward sloping. Source 1 gives the automobile industry historically as an example. As it grew massive, it could get engines, brakes, and other components much more cheaply due to the scale of specialized suppliers.
Fascinating. Constant increasing, decreasing costs shaping the long-run supply. Let's connect this back to policy with that New York City taxi cab example 8.7.
Right. If taxi services were, say, a constant cost industry with free entry, you'd expect the supply curve to be pretty flat, highly elastic. A small fare increase would bring lots of new drivers and cabs onto the streets.
But that's not what happens because of the medallion system.
Exactly. The city fixed the number of medallions the licenses require to operate a cab legally, way back in the 1930s, at around 13,150. And it's barely changed since.
So that essential input, the medallion, is perfectly fixed in supply. Which means, no matter how high the taxi fare goes, the number of legally operating cabs cannot increase beyond 13,150. The long-run supply curve becomes perfectly vertical at that quantity, completely inelastic.
A stark example of how a direct quantity regulation totally overrides the underlying cost structure of the industry and dictates the supply response.
Definitely. It highlights how policy choices can fundamentally alter market outcomes.
Okay, let's use this framework to analyze the impact of taxes, which Source 2 covers well. Two different kinds of taxes. First, a per-unit output tax, like $2 per bottle of wine.
Right. A per-unit tax acts just like a variable cost for the firm. It has to pay $2 for every single unit it produces and sells. So this tax shifts both the marginal cost MC curve and the average variable cost AVC curve straight up by the amount of the tax, $2.
Okay, MC and AVC shift up. What happens in the market short run first?
In the short run, the industry supply curve, which is based on the sum of MC curves, shifts up by $2. Given a downward sloping demand curve, the market price will rise, but by less than the full amount of the tax.
So consumers pay a bit more, producers receive a bit less after paying the tax. What does this do to firms?
Firms are now squeezed. Their costs are up by 2, but the price they effectively receive, market price minus $2, is lower. They are now making losses, P new ATC. So they'll cut back production, moving up their new higher MC curve to meet the new lower effective price. Industry output falls in the short run.
And a long-run consequence.
Those losses are the signal for exit. Firms start leaving the industry. As they exit, the short-run supply curve shifts further left.
Driving the market price up more.
Exactly. And in a constant cost industry, this exit continues until the market price has risen by the full amount of the tax, $2. This restores the price received by the remaining firms back to the original minimum AC level, bringing economic profit back to zero.
So in the long run, under constant costs, who bears the burden of a per-unit tax?
The consumer bears 100% of it through the higher price. The industry shrinks, fewer firms, but the remaining firms operate at the same scale as before.
Okay, that's the per-unit tax. Now contrast that with a fixed tax, like an annual business license fee of $50,000. Doesn't matter how much you produce.
This is totally different because it's a fixed cost. It affects average total cost, ATC, pushing it up, but it does not change variable cost or, crucially, marginal cost, MC.
MC doesn't change. So what happens in the short run?
Since the firm's MC curves haven't changed, their individual supply curves haven't changed, and the short-run industry supply curve doesn't shift either. Output and price remain the same initially.
But wait, their ATC went up because of the fee. So if price didn't change...
They're suddenly making losses. Price is now below their new higher ATC curve.
Okay, so losses again. What happens in the long run this time?
Losses still trigger exit. Firms leave, the industry supply curve shifts left, and the market price starts to rise, just like with the per-unit tax. It rises until the remaining firms are back to zero economic profit.
But here's the twist, right? What happens to the firms that survive?
Because they now have this large fixed cost, the license fee they need to cover, they have a strong incentive to spread that fixed cost over as many units of output as possible. This lowers their average total cost.
Oh, and they actually get bigger.
Yes. The surviving firms increase their individual output levels, Q1 to reach the new higher minimum point on their LAC curve that incorporates the fixed fee. The industry ends up with fewer but larger firms.
That's a fascinating contrast. A per-unit tax leads to firms staying the same size, but fewer of them. A fixed tax leads to fewer firms, but the ones left are larger. Policy choice matters a lot for industry structure.
Absolutely. You have to think through these mechanisms.
Let's quickly ground the basic PMC rule with that trash away ink. Numerical example from the notes. Competitive garbage hauler, total cost TC equals $500 plus 5Q22, market price PP equals $205 all.
Okay. Step 1. Find optimal output $2. We need marginal cost. M by day is the derivative of TD dollars with respect to 0. The derivative of 500 is 0. The derivative of 5 Q2 is 10 kilometers. So M set 10 colors, set 10 kilo with NC 10 kilometers, 250 equals 10 kilowatt. Solve for $2.
Q 350, 10 oral 4 and 25. Turn. So optimal output 2 is 25 units, which might be 2,500 tons here if 2 is in hundreds.
Step 2. Check the shutdown rule. Is PTEC, variable cost, is the part of TC that depends on 2 chillers, so VC equals 5 Q 2. Average variable cost, AVC Q equals 5 QO2. Gary Charles, AVC 5 times 25 times $125. The market price PO2 is $205 fulls. Since P250 is much greater than ABC, the firm should definitely produce. No question of shutting down.
Okay. Step 3. Calculate the profit. Profit total revenue text total cost.
Total revenue, $3 2 series, 250 times 2 times 455. Total cost C times number of 7 plus 5 Q2 equals 500 plus 5 $3 6 2 and 500 plus 3 125 plus 3 125 2 profit 55.
So profit P2E 650 300 625 ET5 is 200 600 $625.
Right. Trash Away Inc. is making a positive economic profit of $625 per period.
And what does that positive economic profit immediately tell us about the long run in this competitive garbage hauling market?
It tells us the market is not in long-run equilibrium. That $26.25 is the signal attracting new entrants. As new firms come in, market supply will increase, the price of $250 will fall.
And it will keep falling
Until the price equals the minimum average total cost, driving economic profit down to 0. We could calculate that minimum ATC point, but the key insight is that the current situation with a positive profit is unsustainable in the long run under perfect competition. Entry will erode it. #tag outro. So we've covered a lot of ground today, from the basic assumptions of competition to the nitty-gritty of cost curves and long-run adjustments. But the core takeaway for profit maximization is surprisingly consistent. The universal rule is always marginal revenue equals marginal cost. And for the special but important case of perfect competition, that simplifies beautifully to price equals marginal cost. That PMC Tom rule, combined with the P Visa's AVC shutdown condition in the short run and the P Visa's minimum LAC zero profit condition in the long run, really governs firm behavior.
And we hammered home that crucial difference between accounting profit and economic profit, understanding that zero economic profit is actually the sign of a healthy, stable, competitive market earning a normal return. Plus, the concept of economic rent explains how even firms with apparent advantages get competed back to that zero economic profit baseline in the long run, with the value captured by the scarce resource itself.
Exactly. It's a powerful framework. Now, for a final thought, something for you to mull over, connecting back to those industry cost structures. We mentioned the traditional auto industry as potentially a decreasing cost industry, right? Benefiting hugely from economies of scale as it got bigger.
Yeah, cheaper inputs due to massive volume.
Okay, now consider the tectonic shift happening right now towards electric vehicles, EVs.
Right.
This requires entirely new supply chains dominated by battery technology, by battery materials, production capacity, things that are currently facing intense demand and, arguably, are scarce inputs with rising costs.
So the provocative question is, could this mandatory technological shift fundamentally change the cost structure of the auto industry? Could the reliance on these new, currently scarce battery inputs temporarily flip parts of the auto industry from decreasing cost back to increasing cost?
And if so, does that negate some of the massive scale advantages held by the giant legacy automakers? Does it perhaps level the playing field slightly, giving smaller, more focused EV startups a better chance to compete because the old rules of scale might not apply in the same way during this transition?
That's a fascinating question. Does a technology shock reset the cost structure and the nature of competition? Definitely something relevant for policy and management students to think about. Great food for thought. That wraps up our deep dive into Section 07's readings for PP 53 of Regal 75. Thanks for joining our study group. We'll catch you on the next one.